Barron's Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, AI is advancing and biotech is booming. Janice Henderson's Andy Acker on obesity drugs and other big investment opportunities in the healthcare sector. And later, more housing hurdles as the price tag for buying a home hits a new record and mortgage rates remain high. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Elizabeth O'Brien, and Jack Howe. So Ben, last week we talked about how the Dow was the little index that couldn't. This week it chugged ahead and actually beat the NASDAQ and the S&P.
It did. I finally don't have to talk about how terrible of an index it is. This week it was the Dow that went higher. It was up 1.5%. The NASDAQ technically rose for a third week, but it was up just 0.003%.
Hey, that's still in the green.
Cha-ching. Still in the green. All right. Really what we saw here was a big reversal. All these stocks in the Dow that have been terrible. The Dow has some tech stocks, but they've been bad. They're just like Salesforce.com and Cisco, not very good. Well, they had great weeks, and a lot of these semiconductor stocks really had a tough time. Other tech stocks had a tough time. And so you really did see this reversal happen, and it was about time for it to happen.
So why did the stodgier stocks outperform, and is it just that the others are just too expensive at this point?
I'm not sure if it's valuation or if it's just more of a technical thing that they've gone up so much that, okay, I'm going to drop into a little bit of my technical jargon, but you have these moving averages that are sort of like give you a sense of where the trend is, and they've shot so far above the moving averages that it's almost to a point where you just can't see buying these stocks anymore, and I think they just needed a breather.
The bond market looked pretty flat on the charts. Anything interesting going on there?
Well, what we've seen is just a steady move lower in yields, and that's actually been pretty good. Municipal bonds as a group have now turned positive on the year, and even something like IEF, which is an ETF that tracks 7 to 10-year treasuries, is only down 0.8% on the year, and that's with the total return. And so we're starting to see bonds are trending in the right way. If things keep going the way that they've been going, bonds don't look so bad.
All right, and in the coming week, we've got another read on inflation.
We do. We get PCE, deflator. That's the Fed's really favorite inflation metric. We got some decent news out of the CPI and PPI. It looks like the deflator is going to be up about 2.6%. Still not quite to the Fed's 2% target, but heading in the right direction.
Housing market is slowing. The labor market seems to be slowing a little bit, which is moving in the right direction, but GDP now over 3%, according to Atlanta Fed.
That's right.
Amazing. All righty, Elizabeth, so as Ben just mentioned, the cool kids had a rough week, but they still just completely dominate this market, right?
Absolutely. NVIDIA has been trading places with Microsoft as the biggest company in the world. It overtook Microsoft this past week, but then slipped back down to number 2. Now, these two tech giants lead a very top-heavy market. Just 5 companies accounted for 60% of the market's returns so far this year. So, yeah.
That's huge. And what people should understand is even if you don't actually own these stocks outright, you still have enormous exposure to them through an index fund or, frankly, most growth funds.
Exactly. And just to put that in perspective, if you have $100,000 in the S&P 500 index, you have over $21,000, about $21,000 in NVIDIA, Microsoft, and Apple alone. Now, if that makes you uncomfortable, you could consider investing in an equal weight index. Now, that holds all stocks in equal fixed amounts as opposed to a market cap weighted index where they're all held in proportion to their size.
I guess the good news at a cocktail party, you could say, yeah, I own NVIDIA. Yeah, a lot of it.
Yes,
Saw it coming.
Absolutely, yeah. I got in early.
Okay, so what if I say, okay, I don't want more exposure to those monsters, but I want some more AI exposure? What are some stocks that would give that to me?
Yeah, well, our colleague Eric Savitz had some ideas. He said there are other AI plays that are attractive, maybe not quite so pricey, including Micron Technology, which makes memory for AI, and I was about to say Cisco, not Cisco, but Corning, which makes fiber optic cables that connect AI server tracks.
And the glass in all our iPhones.
Yep.
Jack, this week you penned the bulk of the annual Barron story on the top 25 CEOs in the country. What's happening in the corner office?
25 names, but 24 companies. Netflix has 2 managerial conjoined executives, I believe the proper term is. AI, as we've been talking about, was a huge theme this year. Half the companies that made the list are involved. Somehow they make chips for AI. They sell cloud computing based on it. They use algorithms to sharpen their pricing and marketing. Some sell electricity to data centers. I think a big theme was the end of excuses. We're 4 years beyond the pandemic. Demand has largely bounced back. Supply chains have eased. Interest rates are more normal than not right now, and inflation is well off its highs. So I think if you're an S&P 500 company out there talking about how conditions aren't great, consider the possibility that it's you, not the conditions. And I'll give you an example. Delta is absolutely killing it right now. And the other airlines are mostly slumping financially. And the problem is not at all air travel. There's loads of passengers out there. Ed Bastian at Delta, he's one of our top CEOs. He invested wisely for years, has been growing premium bookings, the credit card business that they have with Amex. Today, Delta earns 40% of the industry's profit with 20% of its capacity.
How's this working out at Netflix? Two CEOs could be problematic there.
You think that two bosses would not be great for business. There was actually an analysis of this in the Harvard Business Review that said it's better than you think. It's a small sample size, but it works particularly well in businesses where there's technological change, and that's Hollywood. So you've got, Ted Sarandos. He's the guy greenlighting shows and having the A-list celebrities over to his house. And you've got Mark Peters. He's the one who is letting the algorithms decide, and he handles technology and advertising. It's working quite well. There's tons of free cash, and it's funding a content budget that legacy Hollywood just can't match right now.
That is true. Thank you very much, Jack. Exciting innovations in drug discovery are transforming the pharmaceutical industry. Janus Healthcare and Biotech Portfolio Manager Andy Acker on what might be the first $1 trillion healthcare company. That's next. The rise of artificial intelligence is revolutionizing biotech and the healthcare industry with life-changing innovations, creating huge opportunities for investors. Which companies will be the biggest beneficiaries? Joining me now is Janus Healthcare and Biotech Portfolio Manager Andy Acker. Andy, thanks for coming on the show.
Great to be with you, Jack. Thank you.
So you've been covering biotech and the healthcare industry for decades, but you say this is a particularly exciting time. What's the tailwind behind the drug industry?
Yeah, it's a number of factors. I mean, you mentioned AI, and that's one of them. I think AI can accelerate the discovery of new medicines and potentially take that discovery process from 2.5 years down to about 6 months. That will take a while to see, but what we are seeing, especially because of advances in genetic sequencing, for example, where we can now do in hours and for hundreds of dollars what historically cost billions of dollars and took decades. We can now get genetic sequencing information that actually will tell us what are the underlying causes of disease. We're also developing all new modalities of treatment. So it's a really exciting time. Last year, in fact, was a record year with 73 new drug approvals, the most all time.
So despite all this good news, it hasn't been a great time for investors in the healthcare sector. A couple of bad years. Why the differential there?
Yeah, it's interesting. If you think back to just a few years ago when the COVID-19 pandemic hit, the healthcare and biotech sectors were on the front lines of fighting that battle. And whereas historically it took 10 years to develop a highly effective vaccine, we were able to get a few of those in just 10 months. And that probably saved millions of lives. But last year was the year that the global pandemic ended, the public health emergency ended. And so we saw a substantial decline in sales from about 90 billion when it comes to vaccines, therapeutics, and diagnostics for COVID-19 to about 20 billion. And so it was one of the rare years where healthcare had declining earnings. However, the valuations in the sector now we think are much more attractive, and the innovation remains high. So we think we're set up well moving forward.
Yeah, that's the silver lining of bad performance, right? As prices get cheaper. Of course, the big innovation right now is these obesity drugs, and you like Eli Lilly and Novo Nordisk here.
Yeah, we've owned Eli Lilly and Novo Nordisk for the last 10 years. Initially, we were excited about their diabetes franchise. They've taken these same medicines, which are called GLP-1s or incretin-based therapies, and have developed them now for obesity. And obesity is potentially the biggest market that I've ever seen in my career. To give you a sense, these products are already annualizing at over $40 billion and growing over 35% as of the first quarter. So it's widely expected this will be a $100 billion market. And yet the penetration, if you look at the 800 million people globally that have obesity, we're still in the low single digits. So a huge growth opportunity ahead for these companies that are the market leaders.
That is a very large TAM, total addressable market. Another company that is in the hunt, not yet there yet, is Amgen. And you say that that drug might actually be even better than its competitors.
Yeah, I think, first of all, Lilly and Novo are not standing still. Their goal is to obsolete their own products with even better products. And as good as the products are today, and, historically we would only get 3 to 5% weight loss with weight loss medicines. Now we're getting 15 to 20% weight loss. So these are, or even more. So this is really a game changer. And we know now that these therapies can actually reduce the risk of death and heart attacks and strokes. Just recently, we got data on sleep apnea, liver disease, kidney disease. So there are many adjacent diseases that are improved by helping patients lose weight. But you're right. This is still obesity 1.0, and there's many ways to improve on these therapies. We want ones that are better tolerated. These do cause side effects of nausea and vomiting. We want ones, these are injectable once weekly. What if we could give it once a month or even less frequently? What if we could have an oral therapy that's a once a day pill? We also have these therapies that actually cause as much muscle loss as fat loss. And that's not what we're going for. We all want to retain muscle and also lose fat. But you're right. Amgen, we think, is one of those companies that could be in the mix. They are now moving into a pivotal phase 3 study. And we're going to see data, their phase 2 data, their middle stage of testing, will be out later this year. So we're excited to see that data.
Awesome. Andy Acker, thank you so much for these insights. It's certainly an exciting time to be in your business.
Thanks so much for having me.
Home sales dropping as U.S. housing prices hit an all-time high, plus a surprising pivot in which markets are hot and which ones are not. We'll be right back with details. The American dream of owning a home just got a little farther out of reach. The average home price hitting a new high, now costing more than $400,000. The combination of high prices, high mortgage rates, and low inventory making for a tricky housing market. Andrew Berry joins the panel to talk about this market. But first, Andrew, I do want to go to Jack just to get an overview of what's happening out there in real estate land.
Prices are at record highs. There are not a lot of transactions out there. There's a dire shortage of existing homes for sale. Now, home builders are trying to make up for some of that, but it's not enough. You've got people who are locked in. Those annoying people who are bragging about their 2 3/4 that they're locked in at. Those people are the problem. They're not selling. But suddenly in May, inventory of homes is up 19% from a year ago. And then the builder stock's been trading off in recent months. People are wondering if there's a flood of sellers coming, that that's going to be bad for builders. But there's two things to keep in mind. First of all, those inventories are still way below historical averages. And second of all, the houses coming to market, they skew old and expensive. Some of them are sitting there for months without going into contract. It looks to me like people are putting these pie-in-the-sky prices out there, and they're just saying, I hear people are desperate. Let's see if they bite.
Well, maybe eventually they'll finally get realistic and come down in price. Andrew, tell us about this interesting pivot in the market. The once hot markets are now cold and vice versa.
Yeah, what's happening is that the East and West Coast, which had been, are playing catch up now with the Sun Belt, places like Texas, Florida, and Colorado, which had led the market coming out of the pandemic. So you're seeing strength in markets like New York, the suburban area, the Bay Area of San Francisco, and you're seeing weakness in places like Tampa, Florida, which have been very hot, as well as Austin, Texas. So even in the Hamptons, where I'm heading out this summer, the market's very strong. People seem to be obsessed there about climate change, but it's not fazing them about buying homes near the ocean. The same's true on the Jersey Shore.
The paparazzi's been tipped off, by the way.
Yeah.
Go ahead.
Yeah.
You're going to get mobbed now, Andrew.
Yeah. So that means you've been seeing like a flip going on in terms of kind of what's been working and what's not been working as far as home prices.
Yeah, and speaking of the East Coast, Philadelphia recently ranked as the most improved housing market in terms of houses on the market and the duration, the amount of days they spend on the market. Other hot markets are the Nashua area of New Hampshire and Hartford, Connecticut.
There's been weakness in Southwest Florida, and I wonder if it's weather related. There's still damage there from Hurricane Ian in 2022. This year is projected to be one of the worst for storms, and so and you hear about people having trouble buying insurance. So I wonder if that's playing into it.
Could be sharks.
Yeah.
So look, I get it. We're not going to be able to buy houses. We just can't afford them. But we can buy housing stocks. Andrew, should we?
Well, housing stocks have come back. The home building stocks in particular have come back down recently. They had a strong 2023 and early 24. They're down about 10% or so in the past month. Lennar, which is a top 2 builder, reported results this past week. And they were good, not great. The stock traded off a couple percentage points. But I would say the housing stocks are looking pretty good right now. They're trading for about 8 to 10 times this year's earnings. You've got better balance sheets. You've got also industry consolidation means that you're seeing more strength for the big builders. Lennar, for instance, trades for about 10 times earnings. I would highlight with Lennar, they have super voting class B shares, which trade at about a 10% discount to the A shares, and that's probably a better bet. Also, Toll Brothers, a leading luxury home builder, they sell homes for about $1 million or so each, as opposed to about $500,000 for most of the other builders. There, it's about 9 times earnings, stocks around 120, and it could potentially be a takeover target for one of the 2 top builders, as well as potentially Berkshire Hathaway.
What do you like in the REIT market for investors who want access to this sector?
Well, in the REIT market, there are a lot of what they call multifamily REITs, which own apartment complexes, and they've been benefiting because of the housing affordability problem, because you have record prices and higher mortgage rates. People are staying in apartments longer, which means a higher quality tenant base. There are 2 types of them. You've got the coastal ones, which are Avalon Bay and Equity Residential, and the Sunbelt ones, which are Mid-America and Camden. They're all trading around 20 times a key REIT cash flow measure for this year, about 4% dividend yields. And one of the CEO of Avalon Bay said on the most recent call they're having the lowest levels of people moving out to buy new homes now. So that's a bullish development for those companies.
Interesting. Before we go, Jack, we've got about 45 seconds left. What happens if interest rates finally come down?
You would think it would be good for home buyers and good for house prices. The problem is, when rates rose, right, those people got stuck in their homes. Nobody wanted to sell. There wasn't any inventory and prices shot higher. It's the opposite of what you would have expected. So it makes you wonder, is the opposite of what I expect going to happen when rates fall? Maybe a lot more houses will come to market as people move, and maybe it won't be so great for price. You have to kind of think, if it was the opposite on the way up, maybe on the way down too.
Alrighty, good time to be an owner, not so much to be a buyer. Thanks, guys. Elizabeth and Ben have a pair of investment ideas, and Jack explains how a sexual health company burst into the obesity drug business. Stay right there. Jack, we heard about the booming market for obesity drugs earlier in the program. Interestingly, there is a smaller company that's jumping into that business through a loophole.
It's called Hims and Hers. The ticker is HIMS, and it sells, and I don't want any giggling at the table here, erectile dysfunction pills, Jack. And there's other stuff for baldness and pimples and STDs and premature this or that. I think you all get the idea. The stock has gone vertical. It's up 147% this year. And it is not the bedroom stuff. It is the obesity meds, as you say. Hims has started selling compounded versions of branded obesity drugs. It's taking advantage of a loophole for these drugs that are in short supply. And other companies are in on it, too. There's one called Roe. There's a traded one called LifeMD. KeyBank just initiated that at overweight. So we'll have to see how long the free-for-all lasts and when Eli Lilly and Novo Nordisk can catch up with demand. I would not go chasing Hims stock at this point without more guidance from the FDA, Jack. That seems premature.
They get around the patent restrictions with this shortage rule. Huh?
That's right.
Stiff competition. All right.
Oh, no.
Elizabeth, I will go to you now for an actionable idea.
Yeah, that was a tough act to follow, though. We'll talk about Nike, which has been caught flat-footed this year, down 12% on softer demand out of China and also inflationary concerns. And the Olympics could mark, I'm still giggling, I'm sorry,
doing
Jack.
great.
All right, we're talking about the Olympics, which could mark this turnaround for the company. And it's finishing development of some new sneaker innovations, which analysts are very excited about this year. It's having 20% upside.
You should get the gold medal just for that.
I'm sorry.
Absolutely. Michael Jordan is laughing somewhere. Ben, I will go to you. You have a really interesting actionable idea.
Well, mine is Delta. It's, Jack was talking about it. Stock is, it's the best at the airlines. It just raised its dividend to 15 cents from 10 cents. The thing is that it initiated the dividend for the first time after having to cut it during COVID back in December. So it really just did this immediately. That's a really great sign. Citigroup says there's a lot of confidence in it. If you're going to own an airline, they're not great stocks to own most of the time, but if you're going to own one, you want to own Delta.
You go back to 1945. Ben Graham said, do not own airline stocks. For 70 years, he was right. Do I ignore that advice now, or is this really more of a trade than a buy?
I would always say airlines are more of a trade than a buy, but Delta may be the exception.
Alrighty, we'll see. It is a good airline. All right, thanks, guys. Except for you, Jack. No thanks to you. Alrighty, great ideas. To read more, check out this week's edition at barrons.com. Don't forget to follow us on social media for more of your favorite moments from the show. And that's all for us. We'll see you next week on Barron's Roundtable.